Weiss Ratings claims AI is about to have its second wind, and some stocks will 10 times as a result. I cover each stock being pitched in this presentation. Also, I will be traveling abroad to Taiwan for the next 10 days, so this is the last video until November 3rd. I'll still be sending emails daily during my trip, so if you haven't signed up for my newsletter, make sure to do so by clicking the link in the description. Weiss actually gives away the stocks in the presentation, so no need to look at clues. I'm going to give an overview of the companies, dive deep into them, and tell you whether I'd buy. The first stock is Technip FMC, which they describe as an energy technology provider deploying robotics and integrating automation to boost subsea and surface level operations. Here's what to know about this stock. Technip FMC builds and installs the subsea technology that makes deepwater oil profitable. This isn't just equipment sales. They design, manufacture, install, and service entire subsea production systems. Once they're on a project, they're locked in for years. Headquartered in both the US and UK, Technip FMC operates across every major deepwater basin: Brazil, Guyana, Gulf of Mexico, and the North Sea. They're known for one thing: making offshore projects faster, cheaper, and cleaner. In the energy world, that's a superpower. They don't just participate in the deepwater energy boom, they enable it. Technip FMC is riding a major wave of growth as the deepwater market surges, and the company is turning that momentum into massive revenue visibility. In Q2 2025 alone, it secured $2.8 billion in new orders, pushing its subsea backlog to an incredible $16.6 billion, real signed contracts with multi-year timelines and highly predictable cash flows. This isn't hype-driven growth, it's locked-in business from the world's biggest energy players. Technip FMC has become the go-to subsea technology partner for the most ambitious offshore developments worldwide, landing high-value deals with industry giants. Petrobras awarded them major subsea systems and flexible pipework for Brazil's lucrative pre-salt fields. ExxonMobil tapped them for a large-scale development in Guyana, one of the hottest emerging oil regions, and their partnership with Prysmian positions them to supply power transfer systems for floating offshore wind, giving them exposure to the energy transition. These aren't one-off wins. They are long-term, high-margin contracts that fuel recurring, predictable revenue and cement Technip FMC's dominance in the subsea market. Technip FMC isn't just stacking contracts, it's turning them into real cash and putting that money directly back into investors' pockets. In Q2 2025, the company generated $2.53 billion in revenue with strong performance across every segment, proving that demand is translating into top-line growth. EBITDA came in at $521 million, showcasing healthy margins driven by pricing power and operational efficiency. Even better, free cash flow hit $261 million as the company rapidly converts its massive backlog into cash. And instead of sitting on that cash, Technip FMC is aggressively rewarding shareholders. With a buyback authorization exceeding $1.2 billion, over 10% of the entire company, they repurchased $250 million worth of stock in Q2 alone, part of a total $271 million returned to shareholders including dividends. Backed by a strong balance sheet and a $16 billion backlog that already maps out years of future revenue, Technip FMC offers the kind of predictability and shareholder payoff most energy contractors could only dream of. Let's be real, no company is bulletproof, especially in energy infrastructure. Technip FMC has momentum, but they're playing in a high-stakes, high-complexity game with real risks investors must understand. Oil price volatility. If oil prices keep falling, deepwater projects become less economical. When crude drops, big oil tightens capital spending, and Technip FMC lives and dies by big oil's willingness to build massive offshore developments. Sharp declines in oil prices can delay, shrink, or cancel projects entirely. Execution risk. Winning billion-dollar contracts sounds amazing, until something goes wrong. Deepwater engineering is some of the most complex work on the planet. One supply chain delay, cost overrun, or technical failure can destroy margins and crush profitability on a single project. There's very little room for error. Emerging mega competitors Subsea 7 and Saipem are attempting to merge, creating a giant with global reach and scale that could go toe-to-toe with Technip FMC on every front. Technip FMC is already trying to block it in court, which tells you everything. This is a real competitive threat. Local content requirements. Countries like Guyana, Brazil, and Nigeria are enforcing local content rules, forcing companies to hire local labor, source from local suppliers, and build local facilities. Long-term, this builds relationships. Short-term, it increases cost, slows execution, and adds political risk. One regulatory change can alter project economics overnight. Bottom line, Technip FMC is executing well. But this is still an industry where oil prices dictate demand, projects carry massive complexity, competition is heating up, and governments can change the rules of the game with a signature. Smart investors don't ignore the risks. They measure them against the upside. This is a company I like a lot and think it's a buy, but you need to consider the price of oil. Right now, oil is sliding, and this stock will tank if oil prices fall too far. In that case, buy at the bottom. But if oil stabilizes and prices start going back up, I think this stock is great. The second stock being pitched is Garmin, which Weiss explains as a Swiss manufacturer of AI-powered wireless devices, including smartwatches and technologies for automotive, marine, and aviation applications. Here's what to know about this stock. Garmin has executed a masterful transformation into a multi-division technology leader with commanding positions across 5 distinct verticals: fitness wearables, outdoor recreation, aviation avionics, marine electronics, and automotive OEM systems. This isn't diversification for its own sake. Each segment leverages core competencies in sensors, software, and user experience while serving fundamentally different customer needs. The product portfolio spans remarkable breadth. Fenix and Epix watches worn by professional athletes and special forces operators. G3000 integrated flight decks certified in business jets and turboprops worldwide. GPS map and Garmin marine systems trusted by competitive anglers and commercial vessels. Unified cabin digital cockpits winning contracts with major automakers. Garmin's growth story is accelerating through 2025, and it's not a temporary rebound. It's structural momentum built across multiple business segments. The company delivered 20% year-over-year revenue growth in Q2 2025, an exceptional feat for a business of its size and maturity, and full-year guidance calls for $7.1 billion in revenue with earnings per share tracking toward $8. In fitness, as mass-market smartwatch fatigue sets in, Garmin is winning the high-performance segment with multi-week battery life, military-grade durability, and unmatched tracking accuracy. Serious athletes willingly pay premium prices. In automotive, the unified cabin platform marks a true inflection point, with accelerating design wins from major OEMs and industry recognition at CES 2025 validating Garmin's digital cockpit strategy. Meanwhile, strategic partnerships are multiplying the company's value and reach. Collaborations with Meta on smart eyewear, Oakley on sports optics, and an expanding cloud connectivity ecosystem prove Garmin is no longer just a hardware manufacturer. They're embedding themselves into broader technology platforms, creating network effects and deepening customer stickiness. Garmin isn't just growing, it's doing so with world-class financial execution that most companies can only dream of. Its profitability is elite, consistently delivering gross margins around 59% and operating margins near 26%, far above typical consumer electronics or hardware peers. These aren't lucky numbers. Garmin's pricing power, vertical integration, and operational discipline have produced reliable profitability across economic cycles. The strength continues on the balance sheet. Nearly $4 billion in cash and marketable securities, zero net debt, and no financial stress of any kind. This gives Garmin enormous strategic flexibility. Capital allocation further proves their commitment to shareholders, with steady dividend growth, aggressive share repurchases that reduce dilution, and fully funded R&D that keeps Garmin at the forefront of innovation. This is a rare combination. High growth, massive cash generation, fortress financials, and meaningful capital returns. The market consistently underestimates how powerful and valuable that formula truly is. Every great investment opportunity exists because of perceived risk, and Garmin is no exception. The key is understanding these risks clearly and recognizing why they're manageable rather than catastrophic. First, competition is fierce. Apple and Samsung dominate the mass market smartwatch category with massive ecosystems and marketing muscle. Garmin must continuously innovate in premium performance features to maintain differentiation, or pricing and margins could come under pressure. Second, ecosystem integration is a double-edged sword. Recent disputes with Strava and ongoing patent litigation highlight Garmin's occasional friction with partners. If third-party integrations weaken or access gets restricted, Garmin's value proposition could suffer in segments where network effects matter. Automotive also presents significant execution risk. Winning an OEM contract is only step one. Design into production can take 3 to 5 years, and any failure in delivery, reliability, or cost control could jeopardize billions in future revenue. This is a high reward but high stakes expansion. Finally, macroeconomic sensitivity cannot be ignored. Garmin sells premium discretionary products, $800 to $1,200 watches and marine systems costing tens of thousands. In a recession, consumer spending tightens, and fitness/outdoor categories could feel the pain. Garmin is another company I like, but this one belongs on a watch list. It's had a good few-year run, and it's a little overvalued in my opinion. Wait for a dip before entering. The last stock is Ametek, which Weiss says provides AI-enhanced electronic sensors, control devices, and testing systems for industrial applications. Ametek is the quiet giant of industrial technology, an under-the-radar powerhouse that has built a dominant position in critical high-tech niches the modern world can't function without. Rather than chasing headlines like its competitors, Ametek focuses on precision engineering at scale, supplying ultra-precise testing instruments, aerospace components, medical devices, and industrial automation systems that are so mission-critical customers simply cannot replace them. The company operates through two complementary business segments: the Electronic Instruments Group, which delivers high-margin analytical and monitoring technologies with recurring revenue, and the Electromechanical Group, which provides advanced motion control, power systems, and aerospace solutions for demanding industrial applications. Recent performance highlights the strength of this model. The $920 million acquisition of Faro Technologies expanded its leadership in measurement and inspection, while record Q2 2025 revenue of $1.78 billion and raised EPS guidance prove continued execution excellence. AMETEK is one of those rare businesses Wall Street loves, but few truly understand. The AMETEK growth formula is a masterclass in strategic execution, simple on the surface but incredibly powerful in practice. The company consistently compounds returns through a three-part strategy that allows it to win again and again. First, it dominates high-margin niches by building instruments that solve complex technical problems competitors can't touch, thanks to superior expertise, precision engineering, and regulatory approvals that create durable competitive moats. Second, AMETEK positions itself at the heart of unstoppable megatrends such as aerospace recovery, defense modernization, industrial automation, and rising global quality standards, ensuring demand continues to accelerate. Third, it acquires elite technology before the rest of the market catches on, using disciplined M&A to buy specialized capabilities like Paragon Medical, Vertec Vision, and most recently, Faro's 3D measurement suite. But AMETEK doesn't just buy companies, it integrates them, extracts operational efficiencies, and scales profitability across its global platform. This isn't growth by accident. It's a meticulously engineered compounding machine built to expand market share and margins in any economic environment. AMETEK's financial performance is a textbook example of disciplined execution and high-quality earnings. In Q2 2025, the company delivered $1.78 billion in revenue, up 2.5% year-over-year, showing it can maintain growth even in a challenging macro environment. More impressively, AMETEK generated $330 million in free cash flow, converting more than 100% of net income into cash, which is the ultimate sign of earnings quality. Its BB+ credit rating reaffirms investment-grade balance sheet strength and gives the company ample flexibility to continue its proven acquisition strategy. Management's decision to raise full-year EPS guidance further highlights their confidence in continued performance and the successful integration of recent deals. AMETEK's business model is a self-reinforcing flywheel. It converts profit into cash, deploys that cash into strategic acquisitions, integrates those acquisitions with precision, and scales profitability even higher. While most companies hope for consistency, AMETEK manufactures it through operational excellence and world-class capital allocation discipline. A balanced analysis of AMETEK requires recognizing that even the strongest operators face real risks, and maintaining performance at this level demands near-flawless execution. One key challenge is end-market cyclicality. While the company is diversified, sectors like aerospace, defense, and industrial manufacturing can contract during economic downturns, creating potential revenue pressure. Acquisition integration is another major risk, particularly with the Faro deal representing a sizable bet. Any failure to align cultures, extract synergies, or keep the technology relevant could damage margins and weaken the growth story. Cost and supply chain pressures also loom. Foreign exchange swings, persistent inflation, and logistical disruptions threaten gross margins and can turn operating leverage against them. Finally, valuation expectations are high. AMETEK trades at premium multiples, meaning any guidance miss, margin dip, or underwhelming acquisition results could lead to rapid repricing by the market. The long-term opportunity remains compelling, but the bar for performance is set high. Quarterly execution now matters not just for fundamentals, but also for share price stability. AMETEK is the kind of company you buy when you want consistent growth, high margins, and world-class execution, but it's not a set-it-and-forget-it stock. You watch it like a hawk for any slip in performance. When they're firing on all cylinders, this is a compounding machine Wall Street will happily pay a premium for. And don't forget to sign up for my newsletter and get my top 10 stocks to buy and hold. I will be away for 10 days and I won't be uploading any more videos for 10 days, but I will be sending out emails. So if you want to stay in touch these next 10 days, just sign up below.